morning, and it's the Conch Economist, and we are very privileged today to be in the offices of Peter Navaretta, who is a financial planner. Good morning, Pete,
Good morning, Harold.
and
Thank you.
tell us the name of your firm,
The name of the firm is the Investment Planning Group.
and what does the investment planning group do?
We do our financial planning with our clients, and it comes to talking about healthcare costs. I'm just using this as an example. We know that healthcare costs is not the same as inflation on maybe like automobiles. Historically, healthcare numbers and inflation have probably been around 2-3 times the number
Higher than the overall,
than the overall
yes,
inflation.
absolutely, yes.
So it's interesting with our financial planning software, um, it always defaults to 2%. I don't know why. I guess
That's the Fed.
That's the Fed. It always
That's the Fed's
defaults to
dream.
2%. But I'd rather err on the side of caution and
Yes.
be a little conservative. So I always bump those numbers up to probably around the 4% range.
Okay, all right.
And down the road in the future, if I'm wrong, that's great, because that means that your dollar is going to stretch a little bit further.
Yes.
So I try to make it to where it's a little bit uncomfortable, but not that uncomfortable. But there are different areas that we look at. And again, going back to the healthcare, I could put that number at 6-7%, maybe a little bit higher. And just because historically, just seeing how the cost of that is affecting and how that actually erodes your retirement income, especially if you're paying for the private insurance, and even though Medicare is in there, there's still cost involved with that.
In my work, I had to be concerned with future medical care also, and I know historically hospital expenses far and away above the CPI.
Yep, absolutely.
Just shocking. It really is.
And the other part that's with some of the younger clients that I work with, they, from an educational savings standpoint, I'm actually going through that right now. I have 2 kids that are in college, and the costs are astronomical. So it's
even at a state university.
Even state.
University.
Luckily, my daughter, she goes to a private school down in Fort Lauderdale, but she's covered by grants and scholarships, so the cost for her is really not a whole lot. But when you look at it from a planning standpoint, the cost of education goes up almost the same clip as healthcare costs are going up. So you do want to plan for that as well. And those numbers, when I look at those, I'm actually adding inflation a little bit higher because of that as well. So, but inflation is a real thing, and people just don't understand that people get nervous about the markets, and they say, well, I'm gonna go ahead and put my money underneath the mattress. Well,
that's safe.
It's safe, but that dollar you put under your mattress 20 years from now, that dollar is probably only going to be worth.
It went to sleep. It didn't keep up with things.
No, and it's probably only going to be worth 50 cents at that time.
Right.
So
had a good snooze. Right?
It did. Very well put.
Okay.
But yeah, so that's the inflation thing is a concern with.
All right. So we're not going to put the dollars under the mattress. What are we going to do with our dollars? Do you use the old 60-40 rule of stocks and bonds, or what advice can you give to our audience?
The biggest piece of advice that I can give is that we, in our end, with our practice that we run, your financial plan dictate the investments. We don't put the cart before the horse. Like, for example, I'm not going to have a client walk in the door and I look at them and say, well, you look like a 60-40 person. I need to know a little bit more about you. It's kind of like going to the doctors. The doctor wants to know everything about you to make the right prognosis of what to do, what medications, things like that. Now, we have clients that have the financial plans, and they come back and they don't need to be aggressive. So their investments are going to be pretty plain vanilla. We're talking bonds, maybe a little bit of dividend paying stocks, those type of things.
Let's
And then
let's talk about maybe how about a young person and we're interested in say growth. What sectors or industries uh, are you anticipating good, say above average growth in the coming years?
in the coming years, for a young person, um, I still say we're still on the tip of the iceberg with the technology now and the new AI that's coming out. I think having exposure in those type of areas with the growth that's going to be coming, that's happening now and still going to be coming, that's a good area to be in. If we're talking specifics, I still think it's important to have a diversified portfolio, but you could add some extra what we nerdies in our business call alpha.
Right.
You can add some alpha
The
into
search
that.
for alpha.
Yeah, you can
Yes.
add some alpha in there by maybe increasing some of the growth. If you have a longer time horizon
And
to
for
do
our
that.
audience, when we talk about alpha, we're talking about rates of return above average.
Above average,
So
correct.
when you read financial articles and they're talking about the search for alpha, they're talking about something that has grown faster than average, like an Nvidia, for example.
Well, right, like the Mag 7 for the past couple of years.
Right.
What people don't realize is that I think it was 2024 and 2025. The Mag 7, they were responsible for about 95% of the return of the S&P 500. If you strip
Right.
them out from the S&P 500, the S&P 500 returned probably 5%, if that.
Right.
So this year so far, not including what's going on with the war or anything like that, this was already happening before that. You can see that there was a rotation out of those Mag 7 to where there was more participation with the overall S&P 500. So the other 493 companies that were in the S&P 500, they're have more of the legwork this year versus the Mag 7. I'm not saying they're bad or anything. If anything, I would tell you right now that they're probably, most of them are on sale at this point.
Right.
But, it's like Warren Buffett said, the stock market's the only thing that's on sale that people run from.
Yes.
And I would, not really even for a young investor. If you're an older investor and a seasoned investor and you believe in that sector, by all means, buy into that. Maybe not the individual stocks, maybe the actual sector you can buy through an exchange traded fund.
I was going to ask you if you use ETF. You use ETFs in your
We do.
Yes,
We use
I'm
I'm
glad to hear that because I do too.
well, one of the reasons why we do that is it's nowadays it's become very hard to pick individual stocks.
Right.
And some of them at the price points that they're at now, they're very expensive. You look at some of these, like I'll use Nvidia, for example. You want to buy 100 shares of Nvidia, you're spending over $17,000 for that.
There.
Whereas you can buy an ETF where you can still have exposure to Nvidia that may cost half for the same amount of shares.
Yes.
And you're diversifying that risk away too, as well. Because for example, right, this year, a majority of the mutual fund managers. A mutual fund is a little bit different than an ETF that's actively managed.
Right.
If you look at their holdings, especially a growth manager, your top 7 positions are going to be Nvidia, the Mag 7. You can see that their performance is down, but you may not be as hurt because they have other positions in there. So,
do you have preference of ETFs over mutual funds or mutual funds over ETFs?
That's that's a very good question. You can see pundits on both sides about,
which is why I asked you.
Well, I think they're good. Having both of them are good in certain circumstances. Like, for example, you were asking me earlier if there's anything about the 60-40 model. One of the things that we do here is we actually add in most of our models that we create in-house. We don't third party them to anyone. We do everything here. We add an alternative sleeve to our models. An alternative sleeve are investments that are not correlated with the actual equity markets themselves, even the fixed income market. So we're talking maybe hedge funds, market neutral funds, things that zig when everything else zags.
Got it. Now, I
So,
think at this point, I should define for our audience when we say 60/40, historically, financial planners or other people involved in that work have recommended that of your portfolio, 60% of it would be in stocks, 40% would be in bonds, with the
mhm,
idea that if stocks go down, bonds protect you, but if bonds go down, stocks protect you. This was
right,
the balancing act.
right.
But as we have learned here, that's not always the best way to go.
Well, no, at least in our mind, it's not. But again, everyone has an opinion on that, right?
Right.
So, when we look at things, we look at studies, and a perfect study of that was done by J.P. Morgan, where they went in and they added alternatives as a sleeve to a 60/40 model. So what they did was they took basically 20% and added that to an alternative sleeve, so that lowered your equity exposure from 60% down to 50, your fixed income down to 30%, and then they added 20% to alternatives. And what they found over time, over a period of 20-year look back, that if you actually add alternatives in there as a sleeve to your overall investments portfolio, that your risk is actually lower, but your returns increased. So we basically got out of gold and we went into a commodity fund, just to diversify the risk a little bit away from gold. But again, it's one of those things where you're always going to have people that believe in gold. I like gold. I think it's a good investment to have in a portfolio. But
Now,
again,
do you advocate the physical metal or an ETF? How
uh,
do you own gold?
well, in our case, what we do is we utilize the ETF.
Okay,
We use the
the GLD.
GLD, and I think that's one-tenth the ounce of gold price.
All right.
So it's an easy way to track it without having the actual physical gold.
Okay. All right. Well, Pete, I want to thank you. This has been a lot of fun,
Well, thank you.
and it's always good to get somebody else's perspective on things. And I want to appreciate and
Well,
thank you
thank
very
you. I
much for
appreciate it.
being part of the Conk Economist audience here.
Well, thank you again.